The Fed and the Oval Office have been at odds for decades, and Fed Chair Jerome Powell recently said that he will likely wait and see the numbers prior to cutting rates, and that the tariffs are creating fear and uncertainty in the market and need to be resolved sooner rather than later. At the same time, President Trump is saying that Jerome Powell is too late again in cutting rates and that there's no fear of recession or inflation as long as he reacts quickly and cuts rates. So when will the first rate cut come? Is inflation in check? Is there going to be a recession? What's next for the market? And how do we capitalize and position ourselves so that we can survive the market and profit and thrive going forward? Well, in this video, I'm going to talk about two different strategies that are ideal for this market when it's been beaten down and we kind of are in a waiting game and we know the market's going to move up over the next few months. It's just a matter of when. So stay tuned for this video. And whether you're a new trader or a seasoned veteran, there's something in this video for you. Make sure you hit like and subscribe down below. Download the free options workshop in the link below. It talks about the main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research. And if you're the one taking the risk, which you are, then you've got to do the ultimate risk. The ongoing conflict between the White House and the Fed has reached new heights. President Trump's aggressive tariff policies are unprecedented in modern history, placing the Fed in uncharted territory as he tries to balance its dual mandate of controlling inflation and supporting employment. Fed Chair Jerome Powell has issued his starkest warning yet, stating that the scale and unpredictability of these tariffs are creating significant economic uncertainty, which could lead to slower growth, higher unemployment, and persistent inflation, an environment the Fed hasn't faced in decades. The tension has even spilled into public confrontations, with Trump indicating that Powell should be replaced. The Fed, however, is concerned that cutting rates now could further stoke inflation already being pushed higher by rising import costs and supply chain disruptions. The market has responded with sharp volatility. Major indices have seen steep declines, with the S&P dropping over 10% in just 2 days following major tariff announcements. Investors are rattled by policy uncertainty, the risk of a prolonged trade war with China, and fears that the Fed's hands are tied as it tries to avoid both runaway inflation and potential recession. Despite these headwinds, most analysts see a path to recovery later this year. A resilient labor market, potential easing of lending standards, and the possibility of pro-growth policies such as deregulation and tax cuts could help stabilize the economy and drive a rebound in equity markets if trade tensions ease and inflation is contained. For now, however, the market remains highly sensitive to every new headline out of Washington and every policy signal from the Fed. High volatility and sharp market declines like we've recently had are ideal for investors that are ready. This is the time when we can load up, we can back the truck up on quality stocks that are poised for growth. And there's a couple of strategies that are ideal for this that allow time to take advantage and work in our favor so we can collect income in the short term while benefiting from the big upswing that's about to come. The first strategy that we're going to discuss, and one of my favorites, is the poor man's covered call. This strategy mimics the traditional covered call. However, it's more capital efficient. It utilizes a deep in the money call that we're going to buy out maybe a year from expiration date. And then we're going to sell a short-term call against it and collect monthly income. The key considerations are it's capital efficient. The poor man's covered call requires significantly less capital than a traditional covered call, making it accessible for smaller accounts. The profit potential is generally the difference between the strike prices of the long and short calls minus the net premium paid. However, exact profit and break-even points can be complex due to different expiration dates. The risk is the sharp drop in the underlying stock if that happens, which can erode the value of your long call. Losses are limited to the net premium paid for the long call minus any premium received from selling the short call options. Active management is critical. The strategy requires ongoing management as you'll need to roll or replace the short call as it expires and monitor the position for changing market conditions. Another ideal option trading strategy for a market that's been beaten down is the bull put credit spread. So we sell a put that is below the current market price and buy another put further out of the money in the same expiration date. This is a defined risk trade that limits your downside and allows you to profit as long as the stock price stays above your short put price, which is already below the market. We choose a stock or index that we expect to stay above a certain price level. We sell a put at a strike just below the current support or at the level that we believe the stock will hold. We buy a lower strike put to limit downside risk. We want to select strikes that are out of the money, often between 20 and 25 delta, to maximize the probability of profit. And the width between the strikes determines the max risk, while the net credit is the max profit. And as far as maximizing profit potential, we want to enter spreads when implied volatility is high, since the premiums will be richer and will collect more upfront when we place the trade. We aim for a risk-reward ratio that fits our plan, typically risking $3 for every $1 of profit potential. So we want to place a trade that allows us to collect a third the width of the strikes. We typically consider closing at 50% max profit. Once we've collected that, then we can close the trade. Or if our short strike is tested and it's 15 to 20 days out, we can just roll to the next month and collect additional premium. All right, guys, let's go through a couple of live trades on the option trading platform. Okay, guys, let's go through and show both these strategies on the option trading platform. This is the Tasty Trade option trading platform. There's a link down below. There's some benefits if you go through my link. It's a very intuitive option trading platform that I've used for years, and it's very good. So check it out. And the first one we're going to look at is Avago, AVGO, Broadcom. And we're going to do a poor man's covered call. So we're going to go out close to a year. Let's go out to the March 2026. So 336 days to expiration. And we're going to buy, calls are on the left, puts are on the right. We're going to buy the deep in the money call. Let's go to about the 65 delta, so the 160. And we can buy that for $38.80. Now, one option contract controls 100 shares of stock. So that's $3,880. Actually, the mid price is $3,855. Now, keep in mind that controls 100 shares of stock. If you go to the curve mode, you can see, and this is what I like about this platform, you can see the profit zone. If we get up to this $200 range, from there, it keeps going up. And you can see 3,855. If it gets up to this 235 level, 236, we make 2,000. We make back our 38. Well, we not only make it back, we double our money. We make 38.55 after we've made back. Here's the break even right here. So we only need to go to 235, and think about it. It's at 170 right now. If you look at the chart, it was back at 235 just a couple of months ago in January. So if we have a resolution on these tariffs, some good news, and even if it's a slow roll over the next year, it should continue to creep up. Let me know your thoughts down below, what you think. But again, it's a long-term play. We're out a year, and we're looking for the stock to move up slowly and not move down too much further. Now you can see the max loss right here is the amount that we pay. So unlike buying the shares outright, it can't keep going down. This is our max loss, the amount that we pay for the option, $3,855. Now to control 100 shares, if you bought the stock outright, it would be 170. $17,999 times 100, which is $17,099. So this is a lot less to control the same 100 shares. So that's where we're using leverage. Now at the same time, what we're going to do, we're going to click on table mode here. We're going to close this option chain, and we're going to go to the near term. Let's go to the May, 28 days to expiration. So basically a month. And we're going to sell the out of the money. So from 170, where it's trading now, we can sell the 185. We can allow $15 profit and collect $410. So $410 dollars. Actually, we could go the 180 as well and collect almost $600. That's probably not a bad way to go right now, since the tariffs are still in negotiation. But it allows $10 upside on the leaps, which is big. So we would make money if it goes up to 180. And at the same time, we collect $585, so almost $600 in 1 month for selling this. And you can see the price now comes down to $32.65 from the $3,800. So we add that $600 in there. We can do this every month, and as the stock price changes, sell a monthly call against our leaps and profit in both directions. If there's a big move down after I've sold this, I'll close this out and take the profit and then just wait for the move up on the long call. So we can play with it that way as well. But keep in mind, at $600 a month, you would pay off and control these 100 shares for free basically in 5 months. So we hit review and send and place the trade. Okay, the next one we're going to look at is just the Qs. It's the ETF technologies. Look at how it's been beaten down. So I think it's undervalued. You can see the RSI way down. You can see it was just back up at 534, 535 a couple of months ago in February. And what we're going to do is go to the trade page. We are going to go, let's go to the regular option chains, and we can go to the May or June. Let's go May. We'll go closer, and we're going to sell a put spread. So let's look over here at the deltas in the Qs, and we're at 444 right now. Let's see if we can sell the 440, 430. What that will, actually that's $10 wide, and we're collecting $3.18. So basically, we could do 320. So $3.20. The difference between the $10 wide put spread is $10, obviously, and then we collect $3.20 our credit. So that's really, since one option contract controls 100 shares of stock, that's $320. So we collect $320, and we profit as long as this 444 stays above the 440 price. And we're doing this all within 28 days to expiration. So we could hit review and send and place the trade right now. However, let's look at curve mode right now, and you can see the profit zone. As long as we stay above that 440, we keep the max profit 320, and then our break even is the $10 minus the 320 price. And that's our break even right here. Now, if we are tested and the stock price moves down, we can just roll this May out to June and collect more option premium. So this is one of the strategies that I like to use. It's the overall index. We're already down quite a bit, and you can roll this monthly and collect premium. And it's defined risk, so we know our max loss as well. All right, guys, remember to hit like and subscribe down below. Download the free options workshop. Leave a comment, ask a question. Let me know what you're trading and what strategies you're using. I answer every question. Thanks for watching. I'll see you in the next video.